Yeah, and as you say, Japan's been really benefiting over the past uh, 12 months. Really, I think some policy changes there in terms of, as you said, monetary. Also, trying to be more shareholder conscious. I think
Right.
rather than what they were as well. So that's been a really interesting market. If we is there a lot of people I've been listening to have been saying maybe that higher interest rates are actually stimulatory because most of the people who have the assets and the cash are, I guess, in the uh, top part of society. They don't have much debt, so they're basically just getting 5%. Cash paid to them for nothing. Some of these companies like Apple have hundreds of billions of dollars of cash as well. So their income is literally going up just from sitting there and doing nothing compared to what they used to. So do you sort of buy into that? And you could say the opposite as well, that the lower half of society have majority of the debt. So it's yeah, sounds like you don't.
Well, it's really quite funny. Um, so I guess what you're saying is that to fight recessions, the Fed should raise rates, and to fight expansions, the Fed should cut rates. Like so to kill inflation and to say curb demand, you would be advocating that the Fed should cut interest rates because it'll lower interest income. Is that the logic?
Well, probably not cut rates, but it's actually maybe doesn't have as quick an effect on the economy as people expected because there's so much, especially because there's so much
So
US debt out there.
it's a
The Turkish
it,
president would love me saying cut
it's
rates.
interesting. I got 100 years worth of data. Every recession followed a period of rising rates, and every expansion followed a period of reduction in rates. So now we're going to flip history around and say that because of this myopic view that you have companies or even households, you can argue the same. You can, households look at the savings deposits, look at the money market funds, 5% plus. But these people, firstly, they're savers. They don't spend that money. There's nobody looks at the bank account and says, "Hey, honey, we're up $10,000 on our interest. Let's go spend it." They just, it's like dividend income. People might spend capital gains. That's the wealth effect. People do not spend interest income or dividend income. That gets reinvested. On top of that, we have to consider that what causes the recessions and causes the expansions is not necessarily just the impact of what interest rates do on interest income or interest expense. When the Fed raises interest rates, it makes it more costly to borrow money to finance a home or to finance a car purchase or furniture. And then that has all sorts of leakage impacts on the rest of the economy. People talk about services, but services service the goods producing side of the economy, which is usually the first to get hit because they're credit sensitive. So when the Fed raises interest rates, it makes it more expensive to borrow to spend. That impact on the economy is far greater than the impact it's going to have on interest income. And then when the Fed raises interest rates, what does it do to capital spending? Well, if you're a CEO or CFO of company X and you're embarking on a capital spending project, you're always looking at your a priori expected rate of return on capital benchmarked against the discount rate. Well, what happens when the discount rate goes up? Has a huge impact on capital spending intentions. So you can't take a look at something as complex as the US economy and say, well, higher interest rates are just great because it has this sort of impact on interest income. Uh, you have to take a look at the holistic interpretation of what's going on. Uh, as Albert Einstein famously said, the power of compound interest is the eighth wonder of the world, and it has all sorts of influences. But the overriding impact it has, why does the Fed cut rates? The Fed is not cutting rates in a recession with only thing on its mind about cutting interest expense. Um, they're thinking about this will stimulate borrowing activity and it will stimulate spending activity. because the cost of financing big ticket items has gone down. So this notion that you brought in front of me, which I've heard before, by the way, it's basically a ridiculous notion that rising rates are good news for a credit-driven economy, and it doesn't mean that rising rates don't mean that savers benefit. They do. You'd have to come back and say to me, well, this higher interest income is going to be used to work in the economy that companies will take. I mean, you talk about the cash flow boost from their holding of financial assets. Well, what are they doing with that money? So let's say that company X, as you just said, is making more profits because of their financial holdings. Is that staying as part of their retained earnings? Is it being stuck on their income statement, or is it being put to use in the real economy? So these are the things, people just say things that I don't know why, and then people don't even have a real comeback. But there's a reason why every recession was followed by a period of rising rates. And by the way, the traditional lag between the onset of the tightening cycle and the onset of the recession is 2 years. So the Fed first started raising rates in March of 2022, and we are now exactly 2 years later. And what do you know? Let's look at the first quarter. First quarter, housing starts are running negative 9.6% at an annual rate over the fourth quarter average with 1 month to go. Real retail sales are running negative so far in the first quarter, and so is industrial production. And that only happens in an economic expansion historically, 3% of the time. You're 12 times more likely to be in a recession when these three major indicators are going down in tandem in any given quarter: housing starts, industrial production, retail sales volumes. And I just finding so many people are living off last year's fourth quarter and not recognizing that the first quarter is looking totally different. The recession could actually be starting right now. And in fact, the data are telling me that.